Welcome to Invert That. In today's video, we're going to explore one of Warren Buffett and Charlie Munger's most important investing ideas: moats. The purpose of this video is to understand how they identified durable competitive advantages, why some businesses can protect their economics for decades, and why a great business is not just one that earns high returns today, but one that can defend those returns over time.
Right. And to really understand this, we have to look past, the surface level definitions.
Yeah.
We need to dig into the actual mechanics of how capitalism works over decades, not just over a few quarters.
Yeah, exactly. And to put this into perspective for you, let's look at a pretty wild, almost counterintuitive statistic from the sources we're analyzing today.
Oh, the See's Candies one.
Yeah, the See's Candies one. So in 1972, Buffett and Munger bought See's Candies for $25 million. And since that purchase, that single regional boxed chocolate company has produced well over $2 billion in pre-tax profit for Berkshire Hathaway.
Which is just staggering.
Yeah, right. But here is the crazy part. It did that while requiring almost zero additional capital investment. So today, our deep dive is going to reverse engineer exactly how a regional box of chocolates managed to functionally outperform, some of the greatest technological innovations of its era.
Yeah, that's the ultimate mission here. We are drawing from decades of Berkshire Hathaway shareholder letters, transcripts from their legendary annual meetings, and Charlie Munger's really detailed Wesco financial letters.
Lots of reading.
So much reading. But the goal is to change how you look at the commercial world. When you walk into a store or open an app, we want you to stop seeing just the product and start seeing the structural, invisible fortresses protecting that company's cash flow.
I love that framing. So we really have to start with the foundational metaphor that Buffett introduced, right? Because he repeated it relentlessly. During a Berkshire annual meeting, Buffett explained that they view every single business they evaluate as an economic castle. And this castle is protected by a moat. It's a great visual, obviously, but what is the actual economic reality driving that metaphor? What does it mean on the ground?
Well, the economic reality is just the sheer brutality of free market capitalism. I mean, the baseline rule of capitalism is that high returns on capital act like a giant neon sign in the dark.
Just attracting all the bugs.
Exactly, attracting competitors.
Yeah.
If you build a highly profitable castle, say you open a wildly successful coffee shop that generates, a 30% return on the money you invested, the system dictates that someone is going to study your model, lease the building right across the street, and try to steal your riches.
By offering a slightly better or cheaper product.
Yeah. Capitalism is basically a system of marauders. So the moat is whatever structural mechanism makes it either financially impossible or psychologically impossible for those marauders to cross the street and take your customers.
Okay, so inside this castle, you have the management team, and Buffett refers to them as the honest lord of the castle. But I really have to push back on the necessity of this lord if the moat is truly impenetrable.
How so?
Well, let's take an intellectual property moat, right? Disney, as a hypothetical parallel to what they discuss, Disney has arguably the greatest, most deeply entrenched IP moat in human history.
Oh, for sure.
Yet we've seen periods where management struggles or, misallocates capital and the value of the company stagnates. So at some point, doesn't a bad lord actively drain the moat, regardless of how wide it is? Do you actually need both?
That is the exact tension Charlie Munger addressed when he translated this medieval analogy into strict economic terms.
Okay.
During a Berkshire annual meeting, Munger clarified that the honest lord represents what economists call low agency costs.
Low agency costs, meaning what exactly?
Meaning you have a management team acting as true fiduciaries for the owners. They aren't extracting value to enrich themselves with, excessive stock options or doing massive empire-building acquisitions just for their own egos.
Right, they're actually working for you.
Exactly. So the honest lord is low agency costs, while the moat represents the microeconomic advantages of scale or structural market advantages.
But if you were forced to choose, gun to your head, great manager or great moat?
Oh, if forced to choose, the sources are completely unequivocal. Buffett and Munger vastly prefer a great moat over a great manager. Every time.
Really?
Yeah, a brilliant manager in a terrible business, a castle built on sand with no moat, is eventually going to succumb to the macroeconomic gravity of the industry. The tide comes in, and no matter how skillfully the manager swings their sword, the castle just washes away.
So the moat is the only real protection.
Yeah, Munger pointed out that if you have a truly wide moat, the business can actually survive a period of mediocre management. The moat protects the business from the manager's incompetence, at least for a while.
Which brings us to a fascinating question about valuation, I think. Because Buffett and Munger aren't just sitting in Omaha rating castles on a scale of 1 to 10 for fun.
Right. They're deploying tens of billions of dollars.
Exactly. So how does the theoretical width of a moat translate into the cold, hard math of a stock's intrinsic value? How do you put a price tag on a castle?
This is where their philosophy just completely breaks away from modern academic finance. In a Berkshire annual meeting, Buffett laid out his definition of intrinsic value. He said it is the process of estimating the exact amount of cash a business will produce from now until kingdom come.
Kingdom come, right.
And then discounting that future cash back to its present value today.
Right.
It literally compares buying a business to buying a bond that has a century's worth of coupons attached to it. The investor's only job is to figure out what numbers are printed on those future coupons.
Okay, let me stop you there, because discounting cash back to its present value is exactly the kind of textbook finance jargon we really need to unpack for a second.
Fair enough.
The basic premise of discount rates in academic finance is that a dollar tomorrow is worth less than a dollar today, right? Because of inflation and opportunity costs.
Yeah.
So you apply a discount rate to figure out what future money is worth right now. And every textbook, literally every single one, says you use a higher discount rate for riskier businesses.
Standard business school stuff.
Right. If you are valuing a shaky, unproven tech startup, you discount its future cash flows at like 12 or 15%. But if it's a hyper-stable utility company, you use a 6 or 7% rate.
And that is exactly what Buffett and Munger explicitly reject.
Wait, they reject the risk adjustment?
Entirely. In the transcripts, they confirm they do not use varying risk-adjusted discount rates. They generally just use the risk-free U.S. Treasury rate as their benchmark for everything.
Wait, if they only use the risk-free Treasury across the board, aren't they systematically overpaying for risky assets? How are they accounting for the risk that a business might just collapse?
Well, the underlying logic is brilliant, and it is entirely dependent on the moat. They do not use a spreadsheet discount rate to adjust for risk. The moat dictates their confidence in the amount of the cash flows.
Oh, I see.
Yeah, a wide moat doesn't change the discount math. It makes the future coupons a near certainty. If a business lacks a moat, meaning its future cash flows are highly unpredictable.
They just don't buy it.
Exactly. Buffett doesn't try to mathematically save the valuation by slapping a 15% discount rate on it. He just throws it in the too hard pile and moves on.
So the risk assessment happens completely outside the spreadsheet. The moat is the risk management tool.
Spot on.
If the moat is deep, the coupons are certain, and you can just use the risk-free rate to see if the current stock price is a bargain. If there is no moat, no amount of mathematical gymnastics is going to protect your capital.
Precisely. You cannot mathematically adjust your way out of fundamentally terrible economics. And this leads directly to a crucial distinction Buffett made in a Berkshire shareholder letter regarding the difference between the absolute best and the absolute worst businesses.
Okay, break that down.
He categorizes them entirely by how they handle capital as they grow. The very best business, an ideal moat-protected franchise, grows its earnings and throws off more and more cash every year without requiring significant capital reinvestment.
Let's ground this in a mechanism so it's crystal clear. The best business is basically a magical ATM.
I like that.
You walk up to it,
Yeah.
and it spits out more cash every single year. But you never have to pay a mechanic to fix it, you never have to buy expensive software upgrades for it, and you don't have to build a bigger building to house it. It just organically processes more volume and gives you the cash.
That's the ultimate capital light model. Now, compare that to what Buffett calls the worst business. This is a business that might actually be growing its top-line sales rapidly, but it is incredibly capital intensive.
So it's making more money, but
It is forced to reinvest almost all of the cash it generates back into the business at miserable returns just to stay competitive.
so if the best business is a magical ATM, the worst business is like trying to run a high-end restaurant in a town with a collapsing economy.
Oh, that sounds stressful.
Right. You can try to grow by remodeling the dining room, buying a $50,000 espresso machine, and hiring a more expensive chef. You are pouring capital into the business just to keep the few remaining customers from going to the new place down the street.
Yeah, exactly.
You are running on a treadmill, spending all your cash to stay in the exact same place.
Exactly. Or consider the historical airline industry, which Buffett often referenced in letters as a notoriously tough business. If you are an airline and your competitor buys a fleet of brand new fuel-efficient jets with in-seat entertainment,
You have to buy them too.
you have to spend billions of dollars to upgrade your fleet too, or you will lose all your customers. You aren't spending those billions to increase your profit margins. You are spending them for the privilege of staying in the game.
Just to not go bankrupt.
Right. In a capital-intensive business without a moat, growth is actually a trap. It consumes cash rather than producing it. The beauty of the moat is that it liberates cash, allowing the honest lord to take that money and invest it elsewhere.
Okay, so we know why we want a moat and how it drives valuation. It frees up cash. But what are these walls actually built from? Because a moat for a software company looks very different from a moat for a railroad.
Oh, way different.
During a Berkshire annual meeting, Buffett made a subtle but absolutely vital distinction when evaluating consumer products. He emphasized that they look for share of mind rather than just share of market.
And understanding that distinction is really the key to identifying a brand-based moat. Market share is basically a backward-looking statistic.
It just tells you who won yesterday.
Right, it just tells you who sold the most widgets last quarter. The problem with market share is that it can be bought. A competitor can come in, slash their prices to below cost, run a massive marketing campaign, and temporarily steal market share.
Just brute force it.
Exactly. But share of mind is psychological real estate. It means the consumer fundamentally associates the product with a specific feeling, outcome, or identity. They aren't looking for a generic substitute.
Coca-Cola is the ultimate archetype they point to for this, right?
Absolutely.
In the transcripts we reviewed, Buffett notes that at the time, Coke was selling something like 750 million 8-ounce servings a day worldwide, and Gillette dominated the razor blade market. But let's dig into the actual mechanism of that dominance. Why is share of mind so economically powerful?
Because it creates extreme pricing elasticity and absolute predictability. Think about the consumer habit. If someone has a strong share of mind for Coca-Cola, they associate it with happiness, nostalgia, or just the specific chemical bite they crave.
Yeah, they want a Coke, not a cola.
Right. They're not going to switch to a generic supermarket cola just to save 2 cents a can. That psychological lock means Coke can raise its prices slightly year after year, and the consumer will absorb the price increase without a second thought.
Gillette operates on a similar psychological lock, but tied to a different emotion, right? Physical comfort and, frankly, fear of pain.
Yeah, the fear of bleeding on your collar.
Exactly. But Buffett frequently joked about how he liked to sleep soundly, knowing that billions of male hairs were growing all over the world while he slept. But the moat is that men want a comfortable shave. They are not going to risk cutting their face with a cheap, unknown razor brand just to save $1 a month.
The cost of a bad experience vastly outweighs the financial savings.
Right. The brand is the moat because it eliminates the consumer's desire to even shop around.
But, brand is only one architectural style for a castle.
Yeah.
In a Berkshire shareholder letter, Buffett detailed a completely different kind of moat. The structural low-cost advantage.
Oh, this is a fun one.
He highlighted retail operations like Borsheim's, their massive fine jewelry store in Omaha, and by extension, the Nebraska Furniture Mart. He noted that Borsheim's operated at roughly an 18% cost of sales compared to 40% or more at typical competitors.
That is a massive gap. And we really have to explain how that cost advantage is achieved, because it isn't just that they are, frugal or that they negotiate aggressively with suppliers.
Wow, it's structural.
Right. It is a structural systemic advantage.
Right.
Because Borsheim's operates out of a single massive location rather than hundreds of small, high-rent mall stores across the country. Their overhead is a fraction of a national chain's. They save a fortune on real estate, redundant store managers, and complex distribution networks.
And that structural efficiency creates a self-reinforcing flywheel. They take those massive savings on overhead and pass them directly to the consumer in the form of significantly lower prices on jewelry.
Which obviously brings in the crowds.
Exactly. Those lower prices act as an irresistible magnet, drawing in enormous volume. That huge sales volume then allows Borsheim's to buy diamonds and watches in bulk directly from suppliers, securing even better wholesale prices.
Which further lowers their costs.
Yes.
It's basically a thermodynamic loop. If a traditional jewelry competitor tries to match Borsheim's retail prices, the competitor will immediately go bankrupt because they are still carrying 40% operating costs.
The competitor's economic gravity just crushes them.
Right. The low-cost structure is an impenetrable wall because it forces competitors into a suicidal pricing war they mathematically cannot win.
Precisely. Now, we have brand strength and we have low-cost structure.
Yeah.
But there was a third, incredibly potent type of moat that really stood out in the sources, specifically in Charlie Munger's Wesco letters from the late 90s.
Oh, the niche one.
Yeah, it involves a company Wesco purchased in 1996 called the Kansas Bankers Surety Company, or KBS.
This one is fascinating because KBS is the absolute antithesis of a global consumer brand like Coca-Cola. KBS provides highly specialized deposit insurance and indemnity policies, primarily for small and medium-sized community banks in the Midwest.
It's a hyper-narrow niche.
Yeah, there is literally no brand recognition outside of a few hundred bank managers in, like, Kansas and Nebraska. So where is the moat?
Well, the moat is built entirely on specialized skills, relationships, and administrative scale relative to the size of the niche.
Okay, break that down.
KBS understands the specific risk profile of a rural Midwestern community bank better than anyone else on earth. They've been underwriting them for decades. But the true defensive barrier is the administrative friction for outsiders.
Right, because you'd think if you are a giant global insurance conglomerate like AIG, why wouldn't you just step in and steal that highly profitable business?
Because of the scale mismatch. The total market size for this specific type of insurance in the Midwest is relatively small. If a giant insurer tries to enter the market, the cost of training their underwriters to understand these specific rural banks, plus the corporate overhead required to manage the compliance and marketing.
It just completely erases the profit margin on a $50,000 policy.
Exactly. It simply isn't worth their time or capital to even try. Munger points out that there is a huge class of businesses in America just like this. They throw off large amounts of cash, they're deeply entrenched, but they cannot be expanded nationally.
Their moat is that they perfectly fit a specialized niche that is too small for the giants to care about, but too complex for a new startup to replicate.
Yeah, it's a Goldilocks moat.
To really solidify these concepts, let's look at how Buffett and Munger actually applied this by analyzing a few more specific Berkshire acquisitions.
Good idea. Let's start with the absolute crown jewel of their moat education, See's candies.
Yes. In a Berkshire shareholder letter, Buffett detailed the mechanics of how they bought See's back in 1972.
See's is the textbook illustration of what Buffett calls economic goodwill. And this is a term we need to define carefully.
Please do.
When Berkshire bought See's for $25 million, the company only had about $8 million in net tangible assets. That means the physical candy-making equipment, the inventory of sugar and chocolate, the cash at the registers, and the physical store fixtures were only worth $8 million.
Okay, so the remaining $17 million they paid was a massive premium for intangible assets. Let me act as the translator here, because economic goodwill sounds like, I don't know, something an accountant uses to make a balance sheet balance. It sounds like empty air. What is the actual mechanism of economic goodwill?
Economic goodwill is the capitalized value of a company's ability to consistently earn excess returns on its physical assets. See's was not earning high returns because their copper candy kettles were magically superior to competitors' kettles.
Right. Anyone can buy a copper kettle.
They were earning high returns because of a pervasive multi-generational reputation. When someone in California buys a box of See's candies for their mother on Mother's Day, or for their spouse on Valentine's Day, they are not paying for a commodity mix of corn syrup and cocoa.
No, they're paying for emotional insurance. They're buying a guaranteed smile. Because if you buy a generic box of discount pharmacy chocolate for your anniversary,
you are going to be in trouble.
Yeah, no matter how much money you saved, it's a terrible deal.
Exactly. Because the product is tied to a high-stakes emotional event, the consumer becomes entirely insensitive to the cost of the raw materials. See's can price its product based on its emotional value to the purchaser, not its production cost.
Wow.
That pricing power, derived purely from reputation, is economic goodwill in action. Buffett famously noted that he could raise the price of See's candies every single year on December 26th, and the volume of sales never dropped. That is the definition of a deep moat.
Okay, let's pivot from emotional pricing power to the most aggressive low-cost moat in their portfolio, Geico.
Oh, Geico's amazing.
We talked about low-cost moats earlier with retail jewelry, but applying that to auto insurance is a totally different beast. During a Berkshire annual meeting, Buffett explicitly stated that Geico's sustainable competitive advantage is simply being the low-cost producer while providing very good service. But how does that moat become the financial engine of Berkshire Hathaway?
It all comes down to the architecture of the insurance industry. Historically, insurance was sold through a massive, expensive network of local agents who took significant commissions.
Right, the guy down the street.
Geico bypassed all of that. By being a direct-to-consumer insurer selling via mail, then phone, then the Internet Geico structurally eliminated the agent commissions. This allowed them to operate with significantly lower costs than traditional competitors like State Farm or Allstate.
And they took those operational savings and used them to offer lower premium prices to drivers.
Which naturally attracts a massive volume of drivers. But the real magic, the reason this specific moat is so legendary in the investment world, is the generation of float. Explain the mechanics of float, because it is the secret sauce of Berkshire's compounding.
Okay, so float is essentially other people's money that you get to hold and invest. When you pay your auto insurance premium to Geico in January, they immediately deposit that cash. However, they might not have to pay out a claim on your policy until August. Or maybe they never pay out a claim on your policy at all.
Hopefully not.
Right. So in the interim, Geico holds a massive revolving pool of billions of dollars. They get to invest that cash and keep 100% of the investment earnings.
But wait, any insurance company generates float? Why is Geico's float special?
Because of the low-cost moat. Most insurance companies operate at an underwriting loss, meaning they pay out more in claims and operating expenses than they collect in premiums. They only survive because the investment income on the float covers the loss.
Ah, I see.
But because Geico's operating costs are structurally so low, they consistently operate at an underwriting profit. That means they are essentially being paid by their customers to hold and invest billions of dollars.
That is just brilliant.
Berkshire takes this massive, continuously growing pool of costless capital and uses it to buy other moat-protected businesses. It is a compounding machine fueled entirely by a low-cost advantage.
It is brilliant system design. Seas generates massive cash flow through brand love and zero capital requirements, while Geico generates infinite free capital through structural cost efficiency. Now, let's examine one more historical example they discuss, which highlights a type of natural franchise that used to exist. The Buffalo News.
Oh, newspapers.
Yeah, historically, being the only newspaper in a single newspaper town gave you an absolutely bulletproof moat. During a Berkshire annual meeting, Buffett called the local newspaper an exceptional business.
And the reason was that it functioned as a localized, unregulated toll bridge. If you lived in Buffalo in the 1980s and you wanted to know the high school football scores or what was on sale at the local grocery store, who was running for mayor, you literally had to buy the Buffalo News.
Yeah, no alternative.
Exactly. More importantly, if you were a local business, a car dealership, or a supermarket, and you wanted to reach the citizens of Buffalo, you had to advertise in the Buffalo News. There was literally no viable substitute.
But the sources also show, Buffett noting, even decades ago, that this moat was becoming slightly less bulletproof. And that brings us to a critically important part of our deep dive. How do moats weaken? Because these economic fortresses are not invulnerable forever.
They certainly aren't. And understanding the decay of a competitive advantage is just as important as identifying one, right?
Oh, absolutely. One of the primary insights from the sources is that the vulnerability of a moat is directly tied to the fundamental nature of the industry itself. In a Berkshire annual meeting, Buffett highlighted a profound difference between operating a retail business and operating a natural franchise like a local newspaper.
Right. He framed it as the difference between a business where you have to stay smart every day versus a business where you only had to be smart once.
Exactly. The Buffalo News, during its prime, was a smart once business. Once you defeated the competing papers and achieved that monopoly position, the moat was so wide and deep that management could largely coast.
Because the underlying economics protected you from your own operational mistakes. You could have a mediocre publisher, and the cash would still flow because advertisers had nowhere else to go.
But retailing is a daily knife fight.
It really is. Retailing is the ultimate stay smart business. You can build a great low-cost moat like Nebraska Furniture Mart, but every single day your competitors can walk through your front doors. They can look at exactly how you are arranging your merchandise. They can write down your prices. They can observe your customer service.
They just copy you.
Exactly. If you get lazy, if your management stops innovating or lets costs creep up, the marauders will copy your model and cross the moat almost immediately. The maintenance required on the castle walls in retail is infinite and exhausting.
We also found another fascinating vulnerability regarding how power dynamics shift in an industry over time.
Oh, the cereal example.
Yes. In one of the annual meeting transcripts, there was an exchange regarding iconic consumer packaged goods like Kellogg's cereal and Campbell's soup. For decades, these companies were thought to have impenetrable Coca-Cola-level brand moats. But Munger pointed out that their moats actually became less hostile to competitors over time. Why did that happen?
Because the entire landscape surrounding the castle shifted. Munger observed that the buying power in the grocery industry became massively concentrated. Like 30 or 40 years ago, Kellogg sold its cereal to thousands of small, independent grocery stores across the country.
Right, mom and pop stores.
Exactly.
Right.
In that dynamic, Kellogg held all the power. The consumer demanded cornflakes, and the small grocer had to stock them on Kellogg's terms.
But then the giants emerged. Walmart, Target, and Costco completely consolidated the retail side.
And when a retailer becomes a massive behemoth representing a huge percentage of a manufacturer's total sales, the balance of power completely inverts. Suddenly, Walmart can dictate terms to Kellogg. They can demand lower wholesale prices, better placement fees, tighter delivery schedules.
The manufacturer's profit margins just get squeezed.
And it goes even deeper than just wholesale pricing leverage. There is a fascinating psychological shift that occurs with the consumer, too.
Oh, with store brands.
Yeah. When consumers begin to trust a massive retailer's brand, like Costco's Kirkland Signature line, as much as they trust the National Products brand, the moat actually shifts from the manufacturer to the retailer.
That's so true.
If Costco puts their Kirkland label on a can of soup and says it is just as good as Campbell's, millions of consumers believe them and buy it because they trust Costco's curation. The brand moat of the manufacturer is entirely bridged by the trust the consumer places in the retailer.
Which brings us to the most aggressive moat destroyer of all, technology. The sources spend a lot of time discussing how the internet and rapid technological change factor into their analysis. And their conclusion is precisely why Buffett and Munger generally avoid the tech sector entirely.
Right. During a Berkshire annual meeting, Buffett was asked directly about how the internet impacts their assessment of moats. He admitted that they deliberately avoid businesses that are prone to rapid, continuous technological change. He used a wonderful phrase, actually, calling these companies Roman candles.
Roman candles.
Yeah, these are businesses whose moats burn incredibly brightly for a short period, generating massive profits and huge market valuations, but the moat is entirely illusory.
It is illusory because it relies on a specific technological iteration. It is crossed instantly the moment a competitor invents a faster microchip, a more intuitive user interface, or a more efficient algorithm.
It's obsolete almost immediately.
Yeah, the expert takeaway from Munger here is crucial. If a moat must be continuously rebuilt from scratch every 3 years just to survive a technological shift, it isn't really a moat at all. It is just a temporary lead in a never-ending sprint.
But Munger acknowledges that capitalism's creative destruction is fantastic for society, right? It gives us better smartphones, life-saving medicine, cheaper computing power.
Right. But what is great for society is terrible for investment certainty. If you cannot predict what the technological landscape of an industry will look like in 10 years, you cannot accurately predict the future cash flows.
And if you can't predict the cash flows, you cannot calculate intrinsic value.
Exactly. It fails the very first test of their investment philosophy.
So if moats are this dynamic, if they can be eroded by concentrated retailers, destroyed by technological shifts, or breached by lazy management, how can you, as an individual listener, actually analyze and spot a truly durable moat?
The first and most critical step is what Munger calls the filter of understandability. In a Berkshire annual meeting, he explained that opportunity cost is their biggest filter. They do not try to evaluate every single business that crosses their desk.
They just look for a few big, simple ideas that they can actually comprehend.
Yes. If you do not understand the underlying fundamental economics of how an industry operates, you have absolutely no business trying to evaluate the width of its moat.
They only swing at pitches in their strike zone.
Exactly. If a business model relies on complex derivatives, unproven biotech pipelines, or opaque accounting, they just walk away. It goes straight to the too hard pile. But let's say you do find a business that seems simple to understand. How do you verify the moat actually exists?
Well, Buffett frequently talks about his reliance on scuttlebutt, a term he borrowed from his mentor, Phil Fisher. Scuttlebutt basically means getting out from behind the spreadsheet.
Talking to people.
Right. It means talking to competitors, interviewing ex-employees, calling suppliers, and surveying customers to get a qualitative feel for the company's dominance.
But there is a massive caveat that people often miss here. Buffett noted in an annual meeting that this qualitative scuttlebutt approach should only represent the final 10 to 20% of your analysis.
This is a crucial point. The investigative boots-on-the-ground work is only the very end of the process. Why?
Because you must first look at the quantitative reality. You must verify that the fundamental economic numbers of the business look like a 7-footer.
What does he mean by a 7-footer?
What he means is that the financial statements, the persistently high returns on invested capital, the robust and stable gross margins, the consistent generation of free cash flow without massive debt, must clearly indicate that a moat already exists.
So the numbers have to jump off the page at you.
Yes. If the historical numbers look mediocre, if the company only earns a 5% return on capital, no amount of talking to enthusiastic employees is going to magically reveal a hidden moat. The math must strongly suggest a fortress exists. The scuttlebutt is merely the final inspection to confirm your hypothesis and ensure there aren't hidden termites eating the castle walls.
That structural order of operations makes total sense. Now, I want to bring up a really surprising metric from the annual meetings about how a business can actually prove the depth of its moat. It blew my mind when I first read it.
Oh, the adversity test.
Yeah. The true test of a moat is a business's ability to survive intense customer anger or severe management blunders.
It is a fascinating, almost paradoxical test of utility. Buffett cited the historical example of American Express. In the mid-20th century, American Express maintained roughly 2/3 of the worldwide traveler's check market.
Which is huge.
Huge. But here's the kicker. They maintained that absolute dominance despite charging a 1% fee on the checks, while massive, incredibly well-funded rivals like Citicorp and Bank of America were offering the exact same financial product for less or even for free.
Wait, so consumers were willingly paying a premium for the exact same piece of paper just because it had the American Express name and the image of a gladiator printed on it?
Yes, because the brand represented global safety and acceptance. But furthermore, Buffett pointed out historical instances where American Express faced significant unrest and anger from the merchants who were forced to accept their cards and pay high swipe fees. Yet, despite merchant frustration, the business continued to grow.
That's wild. He also used America Online, AOL, as an example from the late 90s tech boom, didn't he?
He did. At one point, a huge percentage of AOL's customer base was notoriously frustrated. They were dealing with constant dropped connections, busy signals, and terrible customer service.
Yeah.
Yet the number of subscribers kept climbing aggressively every single month.
Because the network effect was so strong, customers literally had nowhere else to go if they wanted to access that specific community and interface.
Precisely. Now, Buffett is absolutely not suggesting a company should actively try to make its customers angry.
Obviously.
But he is noting an economic reality. True fundamental utility, a truly deep moat, is proven when a business can take a severe beating, suffer through temporary mismanagement, navigate intense customer frustration, and still thrive and raise prices. If your business only survives because your customers are perfectly happy every single day, and the moment you make one mistake, they flee to a competitor.
Your moat is incredibly shallow.
Exactly. A real moat provides a margin of safety for human error.
Which perfectly circles us back to the eternal tension between the management team and the business model, bringing us to some timeless lessons from the transcripts. During a Berkshire annual meeting, Buffett referenced a famous rule from legendary Fidelity investor Peter Lynch.
The idiot-proof rule.
Yes. Lynch said that you should always try to buy a business that's so fundamentally good that an idiot can run it, because sooner or later, an idiot will.
It's humorous, but it is grounded in absolute observable truth. It reiterates their core preference for the strength of the moat over the brilliance of the manager.
Right.
However, we must provide the crucial nuance here because they don't think management is irrelevant. While the business model's inherent economics are paramount, management still has a vital daily job. In a Berkshire shareholder letter, Buffett stated that his primary overriding instruction to all of his subsidiary managers is simple: widen the moat every single year.
Widen the moat. Notice he does not say maximize quarterly profits or hit Wall Street's earnings estimates.
Exactly. Widening the moat means taking daily actions that cumulatively strengthen the castle walls, even if it hurts short-term profits.
Give me an example of that.
Well, whether that is Costco relentlessly driving their supply chain costs down by hundreds of a percent just so they can avoid raising the price of a hot dog, or See's Candies going out of their way to perfectly resolve a delayed holiday shipment to delight a purchaser. Those actions build the invisible psychological and structural barriers.
So it's about playing the long game.
Yes. Conversely, if a management team makes bad decisions to hit a short-term earnings target, like subtly cutting the quality of the raw materials in their product or reducing the number of customer service reps to save on payroll, they are literally filling in their own moat.
They are giving the marauders a bridge.
And once that brand trust or structural cost advantage is destroyed, No amount of subsequent managerial brilliance will easily rebuild it.
Okay, let me challenge this entire framework one last time. We've established that a great moat beats a great manager, and that bad management can slowly ruin a good moat. But what if you have an absolute generational genius of a CEO? A true visionary? Can a truly great manager structurally save a terrible moat?
Like putting the greatest knight in a mud castle.
Yeah. If you put the greatest knight in the world inside a castle made of mud in a terrible location, can they hold off the marauders and build a lasting empire?
The sources offer a harsh, definitive lesson on this exact scenario. In a shareholder letter, Buffett provides the final conclusion based on decades of his own painful experiences buying textile mills and other terrible businesses. He wrote, "When a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact."
Wow. So the macroeconomic gravity always wins.
Always. Talented management might slow the rate of decline, they might squeeze out a few quarters of efficiency, but eventually, eroding industry fundamentals will overwhelm managerial brilliance. As a wise friend once told Warren Buffett, if you want to build a reputation as a good manager, ensure you buy into a good business.
Do not try to paddle upstream against terrible economics.
It is a futile effort that destroys human capital and financial capital.
So let's synthesize this incredible journey into how these two legends view the commercial world. When Buffett and Munger talk about a moat, they are not talking about a corporate buzzword. They are talking about a highly specific economic fortress.
Right.
This fortress is built on structural foundations: a dominant emotional brand share of mind, a systemic self-reinforcing low-cost advantage, or specialized administrative scale within a hyper-niche market. This moat is the singular mechanism that creates the certainty of future cash flows.
And it allows the business to act like a magical ATM, organically compounding capital and throwing off excess cash without requiring constant massive infusions of new money just to survive the technological treadmill.
And your job as an investor, a business owner, or just a student of human commerce is to look past the shiny product and identify the structural integrity of that moat. You must ruthlessly assess if the business is trapped in a stay smart daily knife fight, or if it enjoys the luxury of having been smart once.
You have to watch the horizon for shifting power dynamics, like consolidated retailers gaining leverage over legacy brands, and you must aggressively filter out businesses whose moats are continuously threatened by the creative destruction of rapid technological change.
We started this deep dive talking about how identifying a good business can feel murky, like looking at a broken X-ray machine. But Buffett and Munger's framework of the economic moat is the ultimate clarifying tool. It cuts through the noise of the stock market ticker, it ignores the hype of unproven technologies, and it simplifies the complex academic math. It gives you a clear structural X-ray of a business's true invincibility.
It really does. And I want to leave you with one final provocative thought to mull over, drawing from a brilliant insight hidden in the 1980s shareholder letters regarding macroeconomic environments.
Oh, I like where this is going.
We spent this entire time discussing how moats protect the business against competing companies. But how do moats behave against the invisible thief of inflation?
Oh, that is a fantastic lens to look through.
A business with a true moat is uniquely biologically adapted to survive and thrive in a high inflation environment. Because it possesses genuine pricing power, that share of mind we talked about, it can increase its prices to match inflation without losing sales volume.
And crucially, because a great moat usually belongs to a capital-light business, it doesn't require massive amounts of new capital just to accommodate the inflation-driven increase in the cost of new factories or inventory. It simply raises prices and continues to spit out cash.
Exactly. So I challenge you to look at the products and services you use every single day and ask yourself, if this company raised their prices by 10% tomorrow, would I actively seek out a cheaper substitute, or would I just pay it?
If the answer is you just pay it, you might just be staring at the walls of a deeply entrenched economic castle.